IVM.
If banks form the heart and the arteries that ensure that money flows into all parts of the economy, persistent bad loans or NPAs become the fat and the cholesterol that clogs up the entire system. In India, we have let this become a chronic illness that continues to affect our banking system a decade and more after the global financial crisis. Former RBI Deputy Governor Viral Acharya joins us on 2 episodes of the Pragati podcast to discuss financial stability, India's NPA problems, as well as to shed some light on his work and his role while at the Reserve Bank of India. Viral is the CV Starr Professor of Economics at the Stern School of Business at New York University. He was at the RBI from January 2017 to June 2019 and has recently published his book, The Quest for Restoring Financial Stability in India. The book features his various lucid speeches while at the Reserve Bank and has a great chapter outlining his views on the Indian economy. Fiscal Dominance, a Theory of Everything in India. The link to check out the book is on our interactive players as well as in the episode description. Before recording this episode, I had reached out on social media and asked for questions from all of you that I could pose to Viral. My thanks to the 45 people who responded and shared some excellent questions. I got a chance to ask Viral about 4 such questions over this and the coming episode. And my special thanks to Ankur Garg, Dayanidhi Krishna, Anua Chakrabarti and Sai Krishna V, whose questions will be featured and will each be getting a copy of Viral's book. Once again, thank you all for participating. This was very much an experiment for me and for the Pragati podcast, and I hope to do this a lot more over the coming episodes. Before we begin, a little reminder. The Pragati podcast is now more than just audio, and each episode contains interactive in-audio links, polls, references, and more. Listen to this episode on the IVM Podcast Android app, the Adori iOS app, or on your mobile or web browsers for the full experience. Visit tiny.cc/Pragati153 to try it out right now. Welcome to the Pragati podcast, a weekly talk show on public policy, economics, and international relations. We take a step back from noisy political debates and dive into rich conversations on India and the world. I am your host, Pavan Srinath. We'll start this episode's conversation after a short break.
Hello, everybody. Welcome to another awesome, amazing, superb week on the IVM Podcast Network. If you're not following us on social media, please do. We're IVM Podcast on Twitter, Facebook, and Instagram. What a week we had this week. We had so much crossover, so many great guests. I don't even know where to start. Okay, yeah, I do know where to start. Let's start with Uncle Please Sit. Uncle Please Sit, Joel and Tushar had Hamsini Hariharan. Hamsini hosts a show called States of Anarchy with their network. She is a China expert, and they discuss the India-China relationship. Really fascinating conversation. Cyrus had 2 conversations this week instead of our normal Thursday Cock and Bull. Great conversations, both of them. We'll be back with our regular Cock and Bull next week. But this week, you could definitely check out the conversation he had with Varun Grover. Really fascinating stuff. And Nikhil Taneja, who was the founder of Yuva and the creative director for the India Film Project Festival, which is going on this weekend. He was on the show as well. Cyrus was also on Advertising is Dead this weekend with Varun Dugirala. Cyrus and Varun discussed Cyrus's intent on randomness. Ranveer Brar guested on Gauri Devi Dayal show. This rounds on me. Another amazing conversation over there. Priyanka Khimani, one of the best IP lawyers in this country, was on Storytellers and Storysellers for a fascinating conversation. Definitely do check that out. And finally, I wanted to congratulate Zarina Poonawalla for her 100th episode. She had Ashish Vidyarthi as a guest on that. If you have not been listening to the Empowering series, please do. It's one of the great shows out there. And with that, let's get you back to your show.
Welcome to the Pragati podcast. I'm Pavan Srinath and I'm here with Professor Viral Acharya in the first of our 2 episodes with him. Viral, thank you so much for joining me. This is a privilege.
Same here, Pavan. I'm delighted to be on the show and I look forward to the interactions.
And I love that you're currently doing what I think Shruti on Twitter called a virtual podcast book tour, right? So you've been also on TV, you've given a lot of print interviews, but you've also been on Amit Verma's Excellent Seen and the Unseen, Shruti's Ideas for India, and now on the Pragati podcast. So it's great that you're also doing the tour of Indian podcasts. And I think this is a great place for us to have long conversations, unrestricted by, time blocks and time slots, and with no shouting or shouting over each other in any manner or form.
Yeah, absolutely. The general feedback I have is that it's much better if my listeners don't see me. The podcasts do much better.
No, and yeah, in a sense, when the podcasts are just in the ear, our hope is that people feel like they're in the same room talking to us.
Yes, absolutely.
So, Viral, in our 2 episodes, I want to talk to you about banking and this massive NPA problem that India has been facing for the last decade. I also want to talk to you and demystify the role of an RBI governor and the RBI deputy governor, because I think from outside they look like esoteric, hallowed positions, and there's so much power and responsibility that comes with that. And I want to understand that a little bit better. And I also want to talk about monetary policy. Now, I want to come in by saying that I am the most ignorant about monetary policy and macroeconomics within the broad fields of economics and public policy. And it's not hard for me to be the idiot in the room here and ask very 101 questions, because that's where I'll have to start my understanding of it either as well. And I find that even in our discourse on so many of these topics, I see a bit of a divide, right? There are people who are active in finance or in investing and who understand what's happening with the stock markets, with the banking system and, the repo rate and more. And many others who perhaps care about India's governance, are concerned citizens, maybe even working professionals in various spaces, who have not too much understanding of this whole financial system, right? So I'm hoping to bridge some of that. And I must say, reading your book, reading your speeches, it was a pleasure that in so many of your speeches, you take the time to start from the 001, not even the 101, and then build that up to important policy conclusions and reforms in your speeches. So that, I hope, will be the spirit of our conversation over the next 2 episodes as well.
Absolutely, Pavan. As far as being ignorant about monetary policy, etc., is concerned, I say welcome to the club. I invite you wholeheartedly, because I think most policymakers are themselves grappling with fairly complex issues that they have not been exposed to before when they do this thing. I always tell my students when I'm teaching that there are no silly questions, there are only silly answers. So I think as far as the idiot box part of this conversation is concerned, it's going to be me, Pavan, not you.
I'll tell you why, because there are friends of mine who work in macroeconomics who I've learned a few things from. I often think of a lot of things in monetary policy as voodoo, simply because when somebody offers me a proper, coherent, cogent explanation, I buy it, I believe it, I think I understand it. And then I listen to a second explanation, which is completely the opposite of it. And I find myself believing that too, right? And perhaps the causal loops that are there in monetary policy, what do you do with the RBI repo, the exchange rate, the bank lending rate, the exchange rate of the currency, the links are so circular in so many ways that what causes what becomes a dilemma at all levels, right? Both in public understanding and I'm guessing in research as well.
Yeah, see what happens with economics as a field, or finance also, is that jargon becomes important. The way you get known for an idea is if you coin a very interesting phrase: moral hazard, adverse selection, asymmetric information. These are phrases for which you get remembered. In fact, these phrases are so crucial that the idea starts getting carried without even reference to the originator of the idea. And, that's like the ultimate impact, so to speak, right? But, of course, when you're trying to communicate the idea, you have to really make it as simple as possible. Now, sometimes what my take on this is that economists are sometimes confused themselves. And so they use the shelter, they lean on the big words to hide behind them, rather than trying to explain things from first principles, because if they try to explain things from first principles, they might actually stumble along the way or have a pretty bad fall or something like that. So I think both are important in my view. I think communicating to the common man should be in simple words, but sometimes to make an idea carry its gravitas, this choice of words and coining up interesting words in the economic jargon is the way the idea actually then becomes like a big theme. It's like a title of a movie or something, If it's like a mouthful, most likely the movie won't get talked about as much. But if it's like one superb word or two superb words, then, it kind of carries through. Now, of course, sometimes it's not enough to use the words, just a couple of words, and then you have to really belabor the idea in its full glory.
Absolutely. And, in fact, I think in monetary policy and macroeconomics, I come across some of these things more because perhaps some of these things are harder to also visualize, right? I can still remember the word taper tantrum. It's a part of India's sort of policy discourse even today. Animal spirits has been with us for almost a century now or so. So, in fact, I see more of these terms being used perhaps in macro rather than in microecon, perhaps because things are otherwise so difficult to grasp that these become anchors that we can use to build our knowledge, right? And so in our first episode that's coming out in this one, I want to talk about banking and NPAs with you, right? And NPA now has also become that it's a 3-letter acronym. We take it for granted. And I actually want to start by saying the idea of a loan as an asset is a very weird thing and a counterintuitive thing for us, right? So because when I take a loan is a liability. I have to pay it back. But for a bank, it's the savings deposit or the fixed deposit I have. That is the liability for the bank. And loans and problematic loans are actually assets, right?
Yeah, exactly. And I think this is a very important point. And I think in a way, if I could just continue the previous theme and then link to it, the goal of my book is that financial stability should actually become a key macro word. I want financial stability to become the word like taper tantrum or, animal spirits or irrational exuberance, which gets talked about a lot, because it is so crucial to the sustainable growth of an economy, the health of the banking sector. And the point you mentioned should be thought of in the following way, which is that exactly as you said, when a household or a corporation takes out a loan, it's their liability. They have to repay it in due course. Now it's your repayments down the line. They are the real asset of the bank, because it's only because you don't have money that you are going to a bank. Now, why are you going to the bank to get the money? Because you want to unlock value. You think you have something productive to undertake. It could be setting up a business, buying a house and consuming your surroundings, or it could be just making an investment. Now, in the process, you are trying to unlock some value and you will be willing to share some of this value with the bank. Now, this value sharing basically creates some margin or profits for the bank. And therefore, it becomes their revenues and bottom line down the line. And therefore, it's their asset. Now, what is very different about this asset than other kinds of assets? Sometimes when we go in the market, we just buy a commodity. Say I buy gold, or I'm buying a stock, or I buy some vegetables. Now, these are cash transactions. And once I give the money to the seller gives me the commodity, and now it's my asset. It's physically with me. In contrast, the loans are in some sense forward-looking assets.
Right.
They are going to generate value down the line, but the bank gives you money today.
Right.
So credit has this component, which is that the money goes from the bank or the credit provider to the borrower right now, but repayments are going to come in future. Because if the repayments were to be made right away, of course, we won't have non-performing assets, because the bank will never lend to you more than what you would be able to repay.
Right.
But it is precisely this backloaded nature of the revenues, and therefore the risks associated with them, which makes banking super interesting. It makes banking super important, because it means people are able to borrow against their unrealized future streams of income that they are generating. So on the one hand, it can create a lot of value in the economy, but it can also create a lot of risks if banks lend too much relative to what can be reasonably generated as repayments from the borrowers.
Right. And I particularly enjoyed, I think, the second chapter of your book, A Bank Should Be Something to Bank Upon. Right. And I loved how you started from the basics. And in that same spirit, I understand that when a bank gives out a loan, at least in theory, they're looking at who the individual or the corporation they are giving out this loan to, and they're looking at the repayment potential of that person or entity that they're giving out the loan to, right? And in case people can't or won't pay back, they're also hoping that there are some assets, there's some collateral that they can use, at least to stem the losses from the bank. So at the level of an individual bank and perhaps a bank manager in charge of giving out loans, can you give us a picture of how this process typically happens? Let's leave out individuals for now. You're a small company or a large company and you're seeking maybe 100 crore loan, from a public or a private sector bank. What might go into that process?
Yes. So, see, banks basically, as we were discussing, they have to give out money upfront, but the payments are going to come down the line. So, banks generally have to collect information in order to assess the likelihood of the repayments from the borrower. So, of course, they will want some formal accounts. They will want to see past transactions that you have done. If you are a company, they will want to see your balance sheets. They will want to see who else you have borrowed money from and how much do you owe others. Because, you can't just go around owing money to everyone, because then the new financier is basically lower and lower in the priority, or they will all dilute each other's repayments when this happens. So usually what is the process is that based on all this information, a bank will try to create something like a credit score. It could be an internal rating that the bank attaches to the borrower or the corporation. It could be an external rating. It could be a mix of both, or it could just be a third party, not even a rating, but like a private credit bureau in case of MSMEs and individual retail borrowers. They will construct some score which will roughly be an indication on a scale of whether you are likely to make a repayment or you are unlikely to make a repayment. And as the scale varies, the likelihood of the repayment keeps changing. Now, typically banks are funded with deposits. Sometimes they may be funded with what are called as interbank liabilities or wholesale finance. So they may not just have deposits from you and me. They may also be borrowing from other financial firms. And usually the bank will have some shareholder capital. They would have made some profits in the past. They may have retained it because the bank may have future prospects of revenues. It can go to the equity market and do an IPO or a secondary equity offering and raise some capital against that. So that will be the shareholder capital. Now, all of these different forms of capital cost money to the bank. You have to pay a certain deposit rate to the retail depositors. You have to pay a certain, typically a somewhat higher rate than that in the wholesale market to other banks and financial institutions. You would have to pay some required rate of return to your shareholders because, they are taking the biggest risk because the shareholder capital gets wiped out the first when a bank makes loss. So factoring all these in, the bank will have what is generally considered as a hurdle rate of return. Now, what's a hurdle rate of return? A hurdle rate of return is the expected return that a bank thinks it can make on the loan for the loan to generate enough value over and above what it needs to pay whoever is financing the bank. So based on the credit score, the bank will then map it into an interest rate that they are charging the borrower. The riskier the loan, typically the higher should be the interest rate. And of course, there are competitive forces at work here. If a lot of banks are chasing the same borrower, then, banks' ability to charge extra return or extra lending rate may be somewhat limited. But all of this, going from a credit score to figuring out a hurdle rate of return, and then figuring out how much interest rate to charge on the loan. And in fact, because there are so many loans competing with each other, the bank will then also take a call. Should I take more risky loans and then have a much higher return, but also higher risk? Or should I lend primarily to safer borrowers and try to make margins from there? So it also has to decide on the quantum of the loan. Now, the key point here is whether the bank is underwriting loans in a manner that's commensurate with what it needs to repay those who are financing the bank. Now, when most of the bank is financed with private capital, which is that it isn't that the government is standing behind the bank or something like that, then the bank is often worried, the banker is worried, the CEO, MD, in fact, even the individual loan officer is worried that, if we don't do this underwriting job prudently and we end up making losses in a few quarters or maybe even a year or two down the line, I may lose my job. Maybe the shareholders will say, why are we putting capital into this bank where the CEO, MD isn't able to ensure that the underwriting processes are of high quality? So with many banks, there are market disciplining forces at work, which limits the extent of risk that they are willing to take relative to the extra premium that they want to earn by lending. Now, why is this point important? It says that while there is internal governance mechanisms that are required to construct the credit score, map the credit score into an interest rate, to portfolio allocation between safe and risky borrowers, ensure that the banker is not making loans to his friends, his or her friends, and instead is lending it to the genuinely deserving borrowers. External discipline is also quite important. And in the case of India, therefore, we have to separate banks into private banks and public sector banks. In case of public sector banks, a big part of the capital structure of the bank, which is how its liabilities are financed, is basically through government backing. Both deposits, firstly, the deposits are mostly insured by the government through the deposit insurance.
That's deposits of savings bank, like my personal account.
Exactly. And deposit insurance extends even to private banks.
Okay.
But what's the big difference? Most of the equity of the bank is owned by the government in case of a public sector bank, more than 50% in fact in India. Whereas for a private bank, the equity is owned by shareholders in the private markets. So, these are investors who have invested in this stock. Now, in general, what has been observed is that the governance of the public sector banks is rather weak. They don't seem to allocate whatever capital they are getting from depositors and the shareholders very well. They seem to be making repeated losses. And this is a pattern across the public sector banks. In contrast, in case of private banks, you have much more dispersion. Some banks are extremely well run. They have really prudent standards, and yet they are able to generate high returns. And occasionally there are governance failures where some CEO or MD is so powerful that they are also controlling the board and managing to actually transfer wealth away from the shareholders into their internal pockets. Now, in both of these cases, when the external discipline doesn't work, you want the regulatory discipline to work. You want the central bank actually to figure out that the governance processes are not right and discipline it. The central bank has good disciplining mechanisms for private banks, but in India, by law, it is very weak in being able to deal with public sector banks. So the long and short of what I'm trying to say, Pavan, is that very interestingly, at the very last point of how a loan is sanctioned, it depends upon the market discipline that the bank faces if it doesn't make good loans, and it depends upon the regulatory discipline that the bank faces in case the market discipline doesn't work. In case of public sector banks, both market and regulatory discipline are weak. In case of private banks, market discipline may sometimes be weak because the CEO MD is too powerful, but then the regulator is still able to exercise powers to get over them. And therefore, underwriting standards, in my view, differ quite substantially between private banks and public sector banks. Even when private banks fail, eventually it's much easier to put them back on the right course. Whereas in case of public sector banks, we seem to be dealing with the same problem and again and again. In fact, I joke that the reason why my ideas on banking are evergreen is because the non-performing assets of public sector banks are always evergreen.
And I'll come to the public sector banks in a bit, right? Because they are the elephant or elephants in the banking room in India. But supposing that a loan is given out with good underwriting, with, good analysis of risk, and with the best of compliance, even then things can go wrong, right? Like, for example, a loan given out in 2007 for a company in infrastructure or something in India, boom, you have the financial crisis that sort of hits us in 2008. One can fairly say that this was, while some people might have seen this coming, for many people this was a shock. In India also GDP was growing at 9-10% a year. That takes a hit. So a lot of the projections for future income for an individual company or a corporation gets tossed out of the window, right? So there can be good faith failures in loans, right? What happens then? When does a specific loan get classified as a non-performing asset, or where the bank decides, you know what, I can't recover this money? How does that typically happen when everything else is going right?
Sometimes loans are just made outright bad. There is either fraud or, there has been some gold plating, which is that you lend too much to a borrower relative to their capacity to repay. That may happen not just because of fraud. It may also happen because of excess competition or some push. Everyone gets caught up in a leverage boom. There may be even behest lending, which the government is trying to push at the time of a fiscal stimulus, etc.
This is sort of priority sector lending and things like that.
It may be even more than that. It may not even be to priority sector. It may be to the large industrialists, because the government is trying to pump prime the economy and generate some short-term returns in infra, power, steel. So it may not just be to relatively unpenetrated parts of the economy. It may be just lending more to those who already have access to a lot of borrowing in the first place, because the government wants to generate higher and higher growth numbers and doesn't have the wisdom of realizing that lending too much in a short period of time and to the same parties will mean most likely you don't have underlying capacity to repay these loans. But regardless of what causes the loans to be made, there may be external shocks that slow down the growth of the economy and cause the loans to go bad, that, the borrower may not be able to repay. It may be entirely beyond the borrower's own faults. Now, whatever it is, whether it's borrower's fault or not, the key point is that the bank has to recognize there is a loss. It has to absorb the loss into its balance sheet and replenish the balance sheet with capital so that it is able to lend again when the economy is beginning to show signs of recovery. Now, what happens in many parts of the world is that when a loan defaults, it is written off fairly quickly. So if 90 days the repayment is not come due, then the loan is considered as a non-performing asset, and then it has to be written off against your balance sheet. In fact, in the extreme cases, in the best governed banking systems, you write down the entire 100% on the loan.
Okay.
Because the idea is that once you have written down 100%, you want to get back, the bank wants to get back as much as possible on this loan. So now they will work hard to actually resolve the distress of the borrower. If that requires going through the bankruptcy code, they will do that. If that requires an out-of-court restructuring, they will do that. But they are keen to get the money back and then put an end to the saga of the bad loan that has arisen.
And importantly, the asset is struck off the asset list, right?
Exactly. It's recognized as a non-performing asset and it's written off. Now, of course, the bank still has some value on its exposure because it can get the value back. And when it recovers the value, typically there is a write back.
Right.
So what was a write off now gets returned back because you got some of the money back. Now, the beauty of this accounting system is that once a loan becomes a non-performing asset, you don't want it to drag on. You want the banks to have incentives to recover on the loan quickly. And the process of writing it off as soon as it is NPA achieves that.
Right.
Now, in many systems, such as in India, it is not done in this manner. You recognize the loan as a non-performing asset. Sometimes, even on that, there is too much forbearance. But even if it is recognized as a non-performing asset, usually the write-off is not done very quickly. In fact, in India, the provisioning, which is to provide for the write-off of this loan, after the loan has already defaulted and not made the repayment for another 90 days, this process in India takes sometimes good 4 to 5 years.
Wow.
Now, what happens, therefore, is that the banker always has to make a calculation. Okay, if I write it off now, if I try to resolve this distress, maybe I will get only 30 paisa on a rupee or 40 paisa on a rupee. Then I have to take a 60 paisa, 70 paisa write-off. Now, the regulator allows me to spread out this loss over 5 years. I am not going to recognize 60 or 70 paisa of loss for 3 years under the regulatory standard. Why should I go and push this firm into bankruptcy and try to resolve it? In fact, if I can, given that I'm not being asked to resolve this asset quickly, can I even give extra money to this distressed firm so that it can keep afloat for a while and I don't even have to recognize it as a non-performing asset, given that the regulators seem so lax in asking me to recognize firms that have defaulted as non-performing assets.
So the bank gives out an extra loan so that the entity can at least pay back its installments on the first loan.
Exactly. So it's
that way the first loan, it's not notionally, there is no default there, there's money coming in. Is that what typically happens?
Exactly. This was most famously known as causing the Japan's lost decade in the 90s. This practice is called evergreening, because a defaulted loan always remains evergreen, because you give it money when the payment is coming due so that it repays the old loan. So you extend the maturity of the old loan effectively by another 3 or 5 years. So sometimes it is also called as extend the maturity and pretend as though everything is okay.
Right.
But this is basically just bad accounting, and it gives the banks very poor incentives to actually resolve the underlying distress. And think about what's happening. The bank, instead of lending this money to healthy, deserving borrowers in the economy, it is now lending to the worst borrowers in the economy. These are now what are called as walking dead or living dead firms or zombie firms. So the bank engages in zombie lending, and all the savings of the economy, the deposits, interbank finance, shareholder capital, which is going into the banking system, is now actually going and getting inefficiently allocated to the worst borrowers of the economy. Now, whether these borrowers defaulted on their own fault or whether they defaulted because of bad luck is irrelevant. You want that the banking system support the sustainable growth of the economy by lending to the best borrowers at a given point of time. And this is why it's important to deal with legacy defaults. It's not because you want to punish the promoter or punish the borrower and put a poster child in the system that, we are going after guys who took bank loans and defaulted. No. Business requires taking risk. Business requires you borrow money. Sometimes you will not be able to repay money. The reason why you want to deal with the legacy assets of your banking system is because you want that whatever new capital is going into the bank or whatever retained capital is had, it is being used to lend to the most productive users in the economy at any point of time. So what has happened in India in part is that we are too obsessed with this idea. We have to punish that guy. We have to punish this person who borrowed. Now, there are always fraudsters in the system. It is very important to punish them and take them through the enforcement actions. But not all borrowers are fraudsters. Some of them are genuine defaulters. But regardless of whether they are fraudsters or they are genuine defaulters, you have to get the banks to resolve the stress of these assets as soon as possible, clean up the banking system, and start lending capital they have to the better parts of the economy. So let me just make one final point here, Pavan, which is that this is zombie lending. Another kind of lending that banks which are stressed with a lot of defaulted assets do is that they just close their eyes and just keep buying government bonds. Why? Right. Because if you keep buying government bonds, default risk is very low. The regulatory standards are such that you don't have to put in any extra shareholder capital of your own. You can just keep funding them with deposits without actually having any skin in the game in buying government bonds for most parts. So you get that these undercapitalized banks, which are not dealing with their legacy defaulters well, they either lend to the zombies or they lend to the government. And this middle tier of firms, which are the healthier firms of the economy in the private sector, it could be individuals like you and me, it may be MSMEs which are run well, it may be the better performing firms and sectors of the economy. Their borrowing costs always remain elevated because banks have no incentive to lend to these borrowers when they have legacy loans problem. So essentially, India's accounting treatment and the incentives that this accounting provides bankers for cleaning up bad assets is extremely weak. I would say it is actually one of the weakest by the global standards.
Thank you, Viral. I want to go in a couple of directions from here on this, right? First, I want to ask, so supposing, let's step away from the bank, but to the entity which is borrowed, right? So you have defaulted on your loan, you're not able to pay back. But maybe apart from having underlying assets which have value, maybe you're also in a place where maybe in a year you can turn things around. Maybe, you have good research and data to say that the demand, say you're working in, I don't know, the oil industry or textiles or some space, if you're able to make a case that things can get better, what is the usual mechanism whereby you negotiate with the bank and say that, hey, I cannot pay back, but work with us, be patient, we can do something. Is there such a process? And if so, does it still have to be struck off as an NPA and something new has to be created where it doesn't become what you said, right? Evergreening or zombie lending, but a new equation between the bank and the defaulter?
Yes. See, the way to do it is to think about these two things separately, which is there may be defaulters who are not worthy of their firms continuing. Maybe they were a promoter who hasn't run the firm well, then there should be a change of ownership of these assets.
Right.
Sometimes there are no future prospects in certain sectors because there's excess capacity. Maybe that firm needs to get liquidated. Right. Or you could have a situation in which the promoter is the right one, the sector is the right one, but there has been a temporary shock. In which case you need financial restructuring. You need that some debt has to be written off. Now that is the right thing to do for the firm. The key point is that what is the right thing to do for the bank also has to be kept in mind. The right thing to do for the bank is that because you don't know with surety whether this is a deserving promoter and firm, whether this is a firm that deserves for the promoter to be replaced but the firm to be continued, or whether this is a firm that deserves to be liquidated, this will only be known over time. And a part of it depends upon how swift your restructuring mechanisms are, how efficient is the time-bound process in your bankruptcy system for dealing with these cases. Now, if that's not quick, if it's going to take more than a year or 2 years for that process to get resolved. In India, it takes sometimes 4 to 5 years or even longer that the cases are not resolved. Now, you can't have a banking system that has not yet recognized these assets as possibly being problematic. Because if you don't write off the loan, as I explained, they will have no incentive to go through this process quickly. Right. In fact, the more protracted and stretched out is the process of recognizing some loss on these loans. By the way, there will always be some loss on a defaulted loan. As long as you are not doing it fairly quickly, they will always have incentives to keep evergreening, do some zombie lending, or at a minimum, do nothing. Just sit on these loans, let them fester, and then even the efficient value of the assets that need to be financially restructured goes waste because the bank doesn't want to do any restructuring because that will produce a write-off that's bigger than what the regulator is asking. My favorite analogy on this is due to a Yale professor, John Giannakopoulos. He said, these accounting systems that don't recognize defaulted loans as written off losses when they occur is like saying a person is coming down from the 100th floor. And when he's on the 75th floor, you just sit tight and say, oh yeah, he's still only on the 75th floor. What is there to worry about? But there is a good chance that he's not just doing bungee jumping or that there is some padding that's going to catch him. There's a good chance he will fall to the ground. You better react right away and recognize that this is a problem. When you don't recognize problems, very often you don't entertain the possibility that the situation may actually, in fact, be quite bad. So what has happened in India is that under these guise that we have to give a soft lending to everyone, everything happens beyond everyone's control. It's right. Partly in the culture of the system that, not everything happens because of you. It happens because of a lot of other factors. And all that is fine. No one is denying any of that. The key point is financial stability. Are your banks going to be in a shape such that they will lend money to the best and healthiest borrowers at reasonable borrowing costs so that the country can generate growth. If your regulatory practices, if your ways of dealing with defaulted firms and defaulted promoters are not ensuring financial stability, you are actually killing off future growth of the economy. And this is not something that the country should be doing on a repeated basis over and over again. In fact, if you talk to economic historians, if you talk to people who have been studying India very regularly since 80s, 90s, in the 2000 decade and thereafter, many of them would say that this is the only way that we have dealt with the country's non-performing assets. You hope that you don't mark down the loans, let banks lend to someone else, and hope that things will come out well. And then in 5 years, you discover, oh, they were actually lending money to the same defaulted firms, or there was no credit growth because they were primarily lending to the government and buying government bonds. So we keep kicking the can down the road. We keep refusing to learn the lessons in spite of our own history. I'm saying, even if you don't want to learn from other countries, such as Japan in 90s or Europe after the global financial crisis, you have your own history to look at, because there is this perception sometimes that India is unique. India's economic system is very different. So what works everywhere doesn't work in India. Okay, fine.
The Indian exceptionalism, right? Which is there everywhere.
But I'm saying even look at your own exceptionalism then. Even just track India's own history. This has simply not played out. The bad loans that were made in the fiscal stimulus of 2009 to 12, we have still not cleared up the legacy loans problem of banks with this time. And therefore, I'm making a very strong appeal in the book that we need to change this for good if India is to deliver on its promise of attaining 7, 8, 9% growth rates on a sustainable basis for 2 to 3 decades. Then you need a healthy financial system. It's like lifeblood, right? You need clear arteries for the blood to flow in your body. The same way you need banks which are in healthy shape for finance to flow to different parts of the economy and energize the various organs of the economy to generate growth.
So you've actually pointed out a fascinating dichotomy, Viral. One is that there is, and I like quote unquote kindness, right? That is there in this system where you want to be kind to a defaulter and sort of give them leeway. But on the other extreme, when things come out, you want to vilify and demonize, people who have taken, public money or money from a bank and defaulted because they are evil, right? So we are pushing people to either extreme, either forbearance and sort of acceptance and leeway, or, do a witch hunt, we'll burn them at the stake. Right? And that dichotomy is deeply problematic, right?
Yeah, it's absolutely, because see, what happens is it's very easy to blame a few individuals. Why do people adopt the policy of having poster child problems? Because you can just focus attention on a few individuals. Usually, when you have a problem of 10 lakh crores of bad loans, it is not about 2 or 3 individuals. The malaise is much deeper. It's in the system itself. It's in the rules itself. It's in the processes. It's in the governance. By focusing attention on a few poster children, you deflect attention from the failures of the system as a whole. And in fact, most of the emails I get in my individual mailbox about bank loan problems in India, I would say more than 50% are about specific individuals, because everyone wants to put blame on a few individuals. Now, they don't realize that what is it in the institutional mechanisms of the country that allowed these individuals to actually get away with this. And actually, they did not cause a 10 lakh crore problem. That 10 lakh crore problem has been built because several sectors, several companies, and several individuals, not just the ones who borrowed, also the ones in the banks, sometimes those who pushed banks to make the loans from the government, sometimes the weaknesses in the regulatory system, and the central bank actually being too soft in its regulatory standards and adopting forbearance under the fiscal pressures from the government. All of these institutional mechanisms contribute together to a weakening of the financial stability as a whole. How difficult would it be if just 2 companies had bad loans in India? And those were the companies of those 2 or 3 poster poster children.
I mean, we could leave that to the courts and,
we could leave it to the courts. We could even write it off. It would not be a problem at all. The reason why Indian banking system is sometimes crippled for lending to the healthy parts of the economy is not because of those 2 or 3 people. They are just manifestations of the deeper underlying malaise that the country's institutional safeguards to retain financial stability on a secured basis have weakened substantially over a period of time. And what I try to explain in the book, Pavan, is that this is because the government is trying to do too much. It's trying to partly use public sector banks, public sector financial institutions, such as in the insurance sector, in the power finance corporations, etc. Collectively, it's trying to use all these entities to keep doing more and more through its own programs, through its own balance sheet. And because it is not working well over a period of time, it then leans on the central bank to not actually recognize the losses, because then it would have to put money into the public sector banks. It would have to deal with the power sector losses. It would have to recognize that the insurance companies aren't generating as high a return as they could if they were not all just buying government bonds in very large quantities. And so there is this what I call as fiscal dominance, which is that the fiscal pressures of the government are now compromising the financial stability of the system as a whole, where you are keeping your bank arteries for sending finance to the organs of the economy clogged. And you constantly keep doing that because you don't want to do the tough adjustment of getting physically fit in the fiscal balance sheet in the first place.
Thank you so much, Viral. Let's take a quick break and I'll come back, and I want to spend a little more time on the regulator, right? So now, given that this problem is there, what can the RBI do? What are the regulatory tools, handles, and specific measures that the RBI or anyone else can take such that we can start addressing problems? And I want to talk about what all has happened in the last decade, both in your tenure and before your tenure in this process. Before we break, dear listeners, don't forget to listen to this episode on the IVM Podcast Android app, the Adori iOS app, or on your mobile or desktop browsers to get the rich new experience. I would also like to thank the Takshashila Institution and IPSMF, the Independent Public Spirited Media Foundation, for making the Pragati podcast possible.
नमस्ते, मैं हूं सौरभ चंद्रा
और मैं प्रणय कुटस्थाने।
जब महफिल खत्म होते होते दरवाजे के बाहर पुलिया के ऊपर हम दुनिया भर की जटिल समस्याओं को सॉल्व करने में लग जाते हैं तो हो जाती है पुलियाबाजी।
अब आजकल के अपार्टमेंट वालों ने तो कभी पुलिया देखी नहीं होगी, पर आप फीलिंग तो समझ ही सकते हैं।
तो आइए शामिल हो जाइए हमारी पुलियाबाजी में, जहां प्रणय और मैं एक से एक इंटरेस्टिंग टॉपिक्स की तह तक जाएंगे।
आर्टिफिशियल इंटेलिजेंस, बिटकॉइन, पाकिस्तान, मेडिकल एजुकेशन, करेंसी क्राइसिस, कभी हम दोनों के साथ और अक्सर स्पेशल एक्सपर्ट गेस्ट की कंपनी में।
सुनिए हमें IVM की वेबसाइट, ऐप या अपने फेवरेट पॉडकास्टिंग प्लेटफॉर्म पर हर दूसरे हफ्ते।
Hi, I'm Pavan Srinath and welcome back to the Pragati podcast. I'm here with Viral Acharya and we've been talking about the problem of banks recognizing non-performing assets and how not doing so fundamentally affects the financial stability of the country, and how the best people and the most deserving entities in the country actually don't get credit, and we actually hamper the growth of the country if we don't get this right. So, Viral, the NPA problem, as you mentioned earlier, it's something that we still haven't solved the mess that sort of started just after the financial crisis, right? And, my good friend Anupam Manor, who's been on the show before, one of the things he likes to talk to me about is this idea of macroeconomic karma, right? And I think in reading your book and reading your speeches, I saw sort of a lot of the similar ideas being repeated, in that when there is something that goes wrong, right? Say when we enter into a problem of, a big NPA crisis or any other large macroeconomic crisis of some sort, there has to be pain involved, right? There can be pain that we can undergo today and while dealing with the problem, or we might have to deal with, 10 times the pain 10 years down the line. But that there's almost a karmic relationship there, right? Where we can't escape the pain of doing the necessary things like writing off a loan in an individual bank or cleaning up the banking system as the entire country. Would you agree with this broad idea?
Absolutely. In fact, I would put it in a variety of ways, which is that, there is also this concept, since you used karma sort of from the Indian language, there is a concept in Indian scriptures and mythology of, preyas and shreyas. Preyas is something that gives you a lot of short-term joy. And shreyas is what is actually the right thing to do. So preyas generally leads to short-term gratification, but it doesn't actually give you long-term happiness. Shreyas very often involves short-term costs, but is actually going to be the right thing, the right structural thing for you for long-run stability. And I think, and that's sort of very fancy Sanskrit terms. In fact, to use a cricket analogy, it's about playing a T20 versus playing a test match. Now, sometimes you are playing a T20, but life of an economy is not a T20. In fact, it's even longer than a test match. It's like, it's like a whole series of test matches, one after the other. And so you can't approach it like a T20. You have to actually dig in. Sometimes when 4-5 wickets are down, you have to play out the session by scoring very minimal runs, because you have to actually settle in, wear down the external forces, your opponents, get your eye in, start seeing the cricket ball like a football, as they say, and then you can actually start thinking about scoring runs again. And this is the inherent trade-off. Our approach to our banking sector has always been, I need 8% growth next year. In the next quarter, I need 8% growth. If banking system doesn't lend, I'm not going to get 8% growth. Now, what we don't realize is that we have just seen in the last decade that if you try to create short-term 8%, 9% growth, but by getting the banking sector lending when it is not in the right shape to lend, when you could be asking it to do too much, and when you don't have the processes right for actually accounting for the risk of the loan, underwriting quality, governance, recognition of losses, etc., then this can be a problem for a whole decade. You could lose an entire series because you wanted to play 1 or 2 sessions every test match like you were playing a T20. So that's just not the way to go about a macro. Once in a while, it's understandable. Maybe for a quarter, for 6 months, like a COVID kind of a shock, you want to postpone the recognition of bad loans for 6 months. That's perfectly understandable. But this cannot be a policy in a normal year. See, even in normal years, there are so many sectors where we keep giving relief. We will not recognize your assets, even if they are restructured. We will not recognize them for losses on the bank balance sheet. In 2016, in 2017, in 18, there is always some sector with which we are doing this. And when we had the fiscal stimulus problem, we did this across board, across all sectors for 3-4 years. This is now not an exception. This is the rule. So the rule in the Indian regulatory forbearance is that we will do it all the time without sunset clauses. Whenever there is a problem, there is pressure on the central bank from bankers, from the government, from the industry saying, don't recognize the loans because we have to generate 8% growth next quarter. Now, the only way you can generate 8%, 9% growth quarter after quarter after quarter and in a stable, sustained manner is if your banking system is kept healthy at all the time. So I fully agree that if you don't have the right macroeconomic karma, as your friend put it, you will not be able to generate good macroeconomic outcomes for the long run. Sometimes, I lose a tennis match and I realize my shots were not right. Now, I can just say, I must play a match again. Maybe I'll win that one and I can get over this loss. No, I have to go and do the drills. I have to speak to a coach. Where is my forehand not going right? Where is my backhand not going right? Why is my serve not going into the right places? So sometimes you have to put in that hard work of getting yourself structurally right to do well. And I think that's what we don't seem to be doing. Like a big part of the book is dedicated to the balance between the government, the central bank, the real sector, and the banking system. And striking the balance is basically always having a structurally sound macroeconomy so that wherever the growth impulses are arising, if they can be pushed through the government can do a little bit of it. If they are arising in the private sector, they can be pushed through the private sector. The banking system can support both of these. The regulator is always ensuring that the risks are not actually rising at the same time. That kind of well-balanced structural approach is what is required for generating growth. And I understand you have to have animal spirits and optimism and exuberance in the economy. But that in itself is not enough. If hope could make a country great, believe me, every country would be the greatest country on this planet. But hope is not enough. You need to be structurally sound in order to create growth for the economy. And I have to stress here that the reason why this is crucial for India is given our demographic needs. We are still at a low per capita income. We have eradicated poverty in a massive way with the reforms of the 90s and the early 2000s. They involve liberalization. They involve divestments. They involve reducing the presence of the state in the economy. And I think those are the type of reforms that we need going forward, including, I would say, in the banking and the financial system. We need to reduce the presence of the government so that we are not trying to drive the economy just through the government's push. We need every part of the four engines of the economy to be doing its job right, well, and in sync with each other.
So, Viral, I want to go with some of the solutions that you've outlined in the book, some of them that you've actively worked on during your tenure in the RBI as well, sort of one by one, right? So one, what you're saying is that because there is this sort of formal forbearance and guidelines coming out of the RBI because of various pressures, where there's actually an instruction given to banks that certain sectoral loans, the problems need not be recognized immediately, right? I mean, there is forbearance that it comes as policy. But other than that, so if that doesn't come as policy, what is the actual nuts and bolts check that is in place? You had mentioned that when a bank gives out a loan to a company, there's a whole process that's usually involved, right? They have a team of people. There might be a third-party credit rating agency, others who are involved, who will do the homework to say that, yes, you can give out this loan at this kind of a percentage. Are there similarly officers at the RBI who then go and inspect every single bank routinely and sort of look at the books, look at problems and highlight them? Is there an audit type mechanism that happens? What is that layer of regulation that takes place?
See, every central bank has a supervision and regulation department. So the regulation department typically will set the rules for how much shareholder capital needs to be there to bear losses against specific kinds of loans. The higher the risk, typically the higher would be the skin in the game that is required. And it sets the rules for recognition of losses when they arise. What I was describing as, in my view, relatively weak standards in India are for the provisioning and the write-offs that happen. The supervision department is supposed to monitor that these rules are being adhered to.
Okay.
That when non-performing assets are to be recognized, they are being recognized. That there isn't evergreening, there isn't fraud, perhaps, that is taking place, etc., etc. Now, of course, the central bank doesn't have the legal rights to take enforcement actions against fraud, but it can detect frauds and report them to the enforcement agencies and so on. Now, clearly, some of this requires a balance sheet verification, which is the balance sheet being marked in a manner that consistent with the regulatory standards. Some of it also requires actually transaction level supervision. Several actions have been taken in the past against specific private banks, for example. Why were those actions taken? Because there was evidence that on specific loan accounts, they were not recognizing losses well, or there were attempts to do sort of circular lending in order to evergreen, or extend and pretend of certain accounts, etc. So those things have to be done by the supervision department, and there have been some failures here in the past. Many people have commented on that. There is definitely scope and room to strengthen the supervision function. At a minimum, the central bank needs greater staff strength, given the increasing size of India's financial sector, the fact that so much non-bank finance is also growing in the country, and now the Reserve Bank of India is also in charge of the regulation for the housing finance companies. So all of this, means sort of more work. And so even though the supervision function with housing finance is not there, but still the supervisory function needs more specialization. And, there is an attempt to set up a separate cadre inside the RBI to do that. But I think I would stress here one point, which is that this idea that the regulator can have its soldiers in every nook and corner of the country supervising every loan that is being made and ensuring that it is right in all places is a bit too much. This cannot happen. The central bank cannot have the resources. An economy cannot set aside resources of that type to monitor every single transaction at all points of time. You can use more digitization. You can use electronic tracking in order to improve the quality of the loans and their supervision. You can reduce the human interventions, both at banks and in the supervision function, to at least get red alert flags which are more automated and not compromised through human failings. But we have to rely on market discipline also, which is that when loans go bad, shareholders should lose money. And because of that, the boards, which are empowered by the shareholders, should be holding the management, the loan officers accountable for the profits and the losses that they make. And there have to be consequences for them. And a part of the problem and the dialogue that you will see arising is that when these problems arise substantially in the public sector banking, there's a tendency to say that, what was the regulator doing? What was the watchdog doing when all these loans went bad? Now, let's face it, first of all, a part of the loans were made through fiscal stimulus. Banks were explicitly pushed to actually make loans to certain categories. Where the regulator failed, in my view, was not so much supervision, but actually in timely recognition of the losses. They didn't actually write down the bank balance sheets quickly. The central bank engaged in massive regulatory forbearance. And as I discussed, that delays the incentives to actually resolve the assets and collect and ensure recoveries on these loans. So I would say the problem is not fundamentally just with supervision. The problem is partly with the regulatory standards. They are weak for recognition of bad loans. Supervision can be strengthened, but I think all of this has to ultimately be supplanted with also stronger discipline from the shareholders.
Right.
And especially in case of public sector banks, because the principal shareholder is the government, and the government is not able to perform this function well. The government needs to actually relinquish its stakes, let these banks be run by their boards rather than by the Department of Financial Services through the back door. If the boards are empowered, there will be greater accountability. You will appoint people who are more independent and, uphold governance standards at these banks. And, the government can sell its stakes below majority. Let some key shareholders who can bring financial and technological expertise come into these banks. Let these banks improve overall. Maybe some of the better public sector banks can even be reprivatized completely so that, they become as thriving as some of the private banks of the country.
Absolutely. And it's bizarre that this is still considered a wild idea in India, right? Forget the marginal sale of shares in the government banks, but wholesale reprivatization, because they were nationalized to begin with for a variety of reasons that were not entirely sound. And even in 2020, the idea of this, we get caught up in terms like Navaratna and other things and, think of these as shibboleths. But one question here, Viral, is that, so what you mentioned that the rules of the game are not the same for public sector banks and private sector banks earlier in our conversation, right? So in this case, this inspection of the bank books and balance sheets and so on, is that symmetric across private and public sector banks? Does RBI have equal access, or is access itself one of the things that is unequal?
No, access is equal. RBI can supervise all banks, public sector or private banks, with the same level of scrutiny and access. Now, to the extent that certain banks don't have as good processes and digitization, Of course, some of the processes can't be run as well. And, this is one of the problems with public sector banking, which is that they are so strapped for funds that certain kinds of critical checks and balances in their IT systems, etc., are sometimes not in place. They have been past overdue, but the funds are not there actually to invest. Because, when you don't have much capital to lend, how can you invest well in the back office functions, which improve the compliance functions of the bank to the regulatory standards? But I would say still the bigger issue is not that the supervision cannot be uniform across public sector banks and private banks. The bigger issue is that regulation cannot be enforced in a uniform manner between public sector banks and private banks. And why is this? Because the Banking Nationalization Act overrides certain powers of the Reserve Bank of India with regard to public sector banks. The management of public sector banks is appointed by Department of Financial Services. They take the decisions on who is in place and who has to be let go. Can the Reserve Bank of India force the principal shareholder to issue capital? And otherwise, if suppose Government of India doesn't issue capital, can the RBI say, no, we are diluting you? We will force you to issue equity in the markets? No, because the government has those powers. So there are crucial weaknesses in enforcing regulation for public sector banks. And what happens is you don't even reach that point, because that point is anticipated. The pressure on the central bank starts before to weaken the regulatory standards in the first place, because the government doesn't want to inject capital into the public sector banks in spite of the losses that are made. And because they recognize that if you leave it and don't weaken the regulatory standards, in the budget, we will have to make some allocations for capitalization that may require compromising on some programs. Government spit of expenditures is bottomless. And so, you always want to push off recapitalizing the public sector banks, especially if you can get a pliant regulator to say, oh, I will give regulatory forbearance every year on certain kinds of losses that are taking place. This is the fundamental problem, which is that now we have reached a point where the ownership of the banks being with the government is compromising the standards that we need to put in place to have financial stability in the system at all points of time. And it doesn't matter that public sector banks' deposits are safe because they are backed by the government. In the book, I call it as a silent crisis. It's not that depositors start running violently on public sector banks because they've made losses. No. But it is still a crisis because the allocation of capital in the economy is very, very poor. It goes to the defaulted borrowers and to the government, and everyone else gets crowded out, as we said, either in quantity of loans itself, or even if they get the loan, it is at a much higher cost than it would have been. So I think the key problem is regulation, in my view. Supervision can be strengthened, no doubt, both for private banks as well as public sector banks. But regulatory standards have become too weak in order to accommodate public sector banks on an ongoing basis.
Thank you so much, Viral. And here I also have one question from one of our listeners, Dayanidhi Krishna, who asked me on LinkedIn. It's a longer question, but he asked whether some of these audits and investigation reports that the RBI generates, right, on various banks and how they're doing, if there's a problem, if they are released and made public either immediately or, with a 3 or 6 month time frame, would that lead to more transparency and more accountability, in your opinion?
Yes, I like that idea very much. I have actually pushed for this idea even in developed economies, where supervisors generally don't release individual reports of banks. I'm not suggesting that they should release market-sensitive information, but perhaps with a year or 18 months, 12 months or 18 months delay, these reports can be released because they will improve the scrutiny of the supervision function. They will lift the quality of the reports to a much more substantial level.
And shareholders will also be in a position to ask sharper questions of the bank management, right? Saying, why did this happen and what have you done since to stop something like this from happening?
Yeah, there is a caveat, which is that, the one argument against disclosing these reports that is given is that if you disclose the reports, then banks may be reluctant to share certain types of information with the regulator in the first place.
Okay.
In my view, the solution to that is not to actually provide no disclosures. The solution is to actually improve the information gathering processes, make them digitized, reduce the discretion that the banks can exercise in providing this information to the regulator, capture as much information at source. So one of the big proposals in my book is to have a public credit registry. Why not ensure that every single credit transaction from origination to termination is always in a public registry for anyone to actually scrutinize this, based on certain rules and consent-based architecture and so on. So I like the idea very much that at least with some delay, there should be disclosures. I think the other thing the regulators can also do is whenever they adopt forbearance as an exception, and as I said, sometimes it's the rule, it's not even the exception, let them put out a report first.
Right.
What were the reasons that we think we need to give this forbearance? What is the sunset clause? Is it for 3 months? It is for 6 months? If we had given similar forbearance in the past, how has it played out? We don't even have democratic accountability of this type. So on the regulatory function, a lot of forbearances get struck through backdoor conversations between the government, the industry, the public sector banks and RBI, without actually providing a very transparent process through which the decision to provide the forbearance was reached. And I think this is a problem because it is too much discretion. It ensures that the central bank gets compromised repeatedly in performing its financial stability function and safeguarding the interests of depositors and maintaining banks to be healthy at all times. And so more rule-based decision-making, more transparent decision-making would be good. This will actually strengthen the central bank in saying no sometimes, because it will say, I have to produce a report. And how am I going to justify this decision given the failures of the forbearance mechanisms in the past?
Thank you so much. And, I don't know if we can do justice to this next topic in our episode right now, but I wanted to get a bit of a sense from you about the bankruptcy code that we've introduced in the country. That's been a work in progress over the last several years. And in fact, in one of your speeches, I think the R.K. Talwar Memorial Lecture, you even quote Wordsworth, right? You say that oft when on my couch I lie in vacant or in pensive mood, the realization that we have put in place a process that not just addresses the current NPA issues, but is also likely to serve as the basis for future resolutions becomes the bliss of my solitude, right? So, I mean, since your time there and, where we are now in 2020, do you feel like now we have at least tackled one part of the problem? If we look at this NPA crisis as a problem, as a stock and a flow, have we at least started trying to address the flow with this IBC and bankruptcy code process that's come into place?
Certainly, I think I would say the insolvency and bankruptcy code is one of the most important structural reforms of this government, like the flexible inflation targeting regime. It kind of puts an institutional structure on how to resolve the defaulted firms. It's meant to be a time-bound resolution framework. What has been a bit disconcerting is that after its initial success, it has slowed down both in its processing of cases. Right now, of course, it's on hold post-COVID, maybe for another few more months. Hopefully, they will reopen as the economy is reopening too, and the cases will start again. In between, as you know, the Reserve Bank of India had a circular, the famous Feb 12 circular, to direct cases to the insolvency and bankruptcy code that got struck down by the Supreme Court, and now there's a revised circular in place. Overall, I think the progress that we were making in 2017 and 2018 for a quick resolution of the decade-long legacy loans problem has slowed down in the last 18 months or 24 months, in my view. I think that's not a healthy trend. We are not allowing an important institutional reform to deliver its goods fully. Smaller cases are getting resolved relatively quickly. The recoveries are higher than what they used to be, so that's good news. But we need to clean the legacy problem on a swifter basis. We just seem to be going on, and time and tide don't wait for you because you don't want to clean your mess quickly. COVID has hit us in the middle of all this. Wouldn't it have been better if we had dealt with this decade-long problem before COVID hit us. It's not that we knew COVID would come and hit us, but you have been taking too long, and some shock will come and hit you along the way and compound the legacy problems of bad loans that you have, because once a bad shock hits, there will be new bad loans emerging of its own. So I would say it still holds promise. I still think it can be made to work. It can become the basis even for out-of-court restructuring, which is banks can actually ask firms to restructure when problems seem to be brewing, saying, listen, otherwise you'll have to go to bankruptcy, you might lose your ownership stakes, why don't you fix the firm before? So we can actually use it as a fallback option to reduce the number of cases that need to go to bankruptcy in the first place. And so I'm hopeful, but there has been a bit of a slowdown in its use. And I think it comes back to this T20 versus test match, Preyas versus Shreyas, karma versus bad karma or akarma, as one calls it, which is that sometimes I feel the system as a whole doesn't want to structurally position it in the right place for the long run. It's too greedy, it's too hungry for growth in short run, but you can't generate that with compromises. I think we have to get over this jugaad and being practical all the time. Yeah, you have to be practical, and a little bit of jugaad here and there is okay if it's for the right innovation. But that can't be a way of solving problems all the time. Insolvency and bankruptcy code was meant to restructure debts, clean up the bad debt problem of banks, and forget about that problem until the next shock hits.
And in a way where even people can exit, right? I mean, if you're someone who's a promoter of a company which is not working anymore, you need to be able to write that off, figure out, and then if you want to do something new, you do something new, right? You don't want this as an albatross on your neck.
Absolutely. Even the promoter might be better off for the economy doing something else rather than... See, what happens with these bad firms, frankly, what I've observed is that when they are allowed to fester and remain, they start stripping assets, they start diverting cash flows, they get zombie loans from banks, their supervision becomes hard because now the loan is being sometimes put through a lot of round-trip financing that is very hard to uncover. You have to piece together several transactions to know how these games are played. It's a nightmare because you are not doing the right thing. Once you allow the system to slide into hiding the losses, it becomes very difficult to uncover the mess that the system has.
Thank you so much, Viral. So clearly we still have the stock problem from 2010 that is still being resolved, still needs resolution, and sort of the flow problem, right? There's the systemic perverse incentives that are there from government, from the private sector and elsewhere, where, we are unduly accruing more and more NPAs, and we will have to actually wait and see how bad the impact of COVID will be.
Yeah, I think time to act is now, because the post-COVID losses will rise, even though the health curve now fortunately seems to be coming under control. There are shoots emerging, green shoots emerging that the recovery may be taking hold. I'm very happy to see that. But there will be sectors which are going to remain affected for quite some time. They will have to restructure their debts in bankruptcy or outside bankruptcy, and there will be losses for banks. And that's, as you said, that flow problem is going to compound the stock problem that we have. So the time to act is now. Raghuram Rajan of University of Chicago Booth School of Business and I have put out a piece called Indian Banks, A Time to Reform ? And we provide a blueprint of what could be done and how we could go about doing it. I hope that there is some attention being paid to this. There are some takers for some of the ideas. Maybe we don't have the best ideas. Maybe ideas will emerge out of a public debate. But because it, quote unquote, plays as a silent crisis, sometimes there is no impetus unless you create an impetus. And, I'm hoping that by raising the issue and its importance and urgency on a repeated basis, I've been doing it since at least 2009 or 10, I think. I wrote in 2013 an op-ed in Live Mint saying we need to deal with our public sector banks. I did it throughout my term. As I say in the book, this was my checklist manifesto. The most important item was to put the public sector banking in a better shape. I'm not giving up. I'm going to still keep pushing for fixing this because I think financial stability has to be ensured at all points of time if we want to secure growth on a sustainable basis.
Viral, thank you so much for joining me on the Pragati podcast. And I'm looking forward to our second episode where I want to go away from banks and talk to you about, the role of an RBI deputy governor, your time there, and also a little bit about monetary policy as well. Thank you so much for joining me.
Thank you, Pavan. Look forward to the second interaction.
Thank you for staying with us till the end. If you have any questions or comments, do write in to podcast@thinkpragati.com. And hey, if you like the podcast and listen to us on iTunes or Apple Podcasts, please leave us a rating and a review. It'll mean a lot to us. The Pragati podcast is available on the IVM podcast app and pretty much every other podcast app and platform. We are there everywhere.
Whether you're an established sports person or a budding one, or simply a sports enthusiast, join us, Tanvi and Shlok.
We are two passionate pro badminton players talking policy, mindset and everything sport.
So tune in to The Millennial Athlete every Monday.
Only on the IVM Podcast Network.
Trust us, it's gonna be lit.
पेश खिदमत है आपकी शान में हमारे अंजुमन से. Hi, I am Sadaf.
And I'm Arshit. खाने का इतिहास, economics, policy, psychology, सब है मेन्यू पे.
Only on the Nankari podcast every Wednesday. सिर्फ IVM podcast ऐप या वेबसाइट पर या फिर जहां से भी आप अपने पॉडकास्ट सुनते हो.